Hey everyone, welcome to this brand new explainer. Today, we're tackling a massive financial milestone. It's one that almost everyone faces at some point, and honestly, it trips up millions of people. I'm talking about buying a car. For most of us, a car is literally the first major purchase we'll ever finance. But before you just sign a loan agreement and drive away, there is a hidden mechanism working against you that you absolutely need to understand. Let's get right into it.
So let's just jump right in with a question. What do you think actually happens the exact moment you drive a brand new car off the dealership lot? We all love that new car smell, the pristine interior, the flawless paint job, but financially speaking, it's kind of wild. The second your tires hit the public road, a dramatic shift occurs. The car instantly loses a chunk of its value simply because it's officially considered used.
Okay, so here's our roadmap for today. We're going to cover 1. The hidden cost of cars. 2. The math of depreciation. 3. The upside-down trap. 4. Why being underwater hurts. And finally, how to borrow smarter. Let's get to it.
Part 1. The hidden cost of cars. When you think about the expense of owning a car, right, you're probably thinking about gas, oil changes, or maybe fixing a flat tire. But honestly, the absolute biggest cost of owning a vehicle is actually an invisible force. It's called depreciation. Simply put, depreciation is just the loss in value of an asset over time. It happens through everyday wear and tear, getting older, and frankly just the fact that car companies are constantly pumping out newer models. Think about it like a savings account. When you put money into savings, it grows over time. But consumer goods like cars and electronics, they do the exact opposite. They rapidly decrease in value. And look, industry standard depreciation rates are, well, they're frankly brutal. A brand new car typically loses about 20% of its value in the very first year alone. And like we said, a huge chunk of that vanishes the exact instant you drive it off the lot. Then, for years 2 through 5, it keeps losing approximately 15% every single year. But wait, here's the real kicker. That's 15% of its current value, not its original sticker price.
Which brings us to part 2, the math of depreciation.
To really wrap our heads around how this invisible loss compounds over time, let's run the actual math. Imagine you buy a new car for $25,000. That's year 0. By the end of year 1, boom, you lose that massive 20%, dropping its worth down to $20,000. Year 2, you lose 15% of that 20 grand, bringing it down to $17,000. Year 3 takes another bite, dropping it to $14,450. And by year 4, your car is sitting at roughly $12,283. You can literally see the value evaporating right in front of your eyes. Obviously, real-world depreciation changes based on the car model and mileage, but these estimates paint a crystal clear picture.
So the absolutely crucial point here is this one staggering number, $12,717. In just 4 short years, that $25,000 car has lost over 12 grand in value. That is more than half of its original price tag. The car still works perfectly fine. It gets you to work and back. But financially, the market is telling you more than half of its value is completely gone.
Let's move on to part 3, the upside-down trap.
So what happens when this massive drop in value collides with how most of us actually borrow money for cars? It leads directly into what's called an upside-down loan. You might also hear it called being underwater. All this means is that the remaining balance on your loan is actually higher than the current market value of the car. In everyday terms, you owe the bank more money than the vehicle is actually worth.
Let's set up a super realistic scenario based on what so many people actually do. Say you buy a $30,000 car. You don't put any money down, and to keep your monthly payment looking nice and low, you stretch the loan way out to 7 years at a 7% interest rate. Your monthly payment comes out to about $450. Fast forward 12 months, and you've paid the bank roughly $5,400. You're probably thinking, awesome, I've paid off over 5 grand of my car. Actually, scratch that. The reality is, in the early years of a long loan like that, most of that money went straight toward paying interest, not the actual price of the car itself.
And here is where the trap just snaps shut. Let's compare your situation after exactly 12 months. On the left side, because you were mostly just paying off interest, your remaining loan balance is still sitting high, somewhere around $27,000 to $28,000. But look at the right side. The car took that brutal 20% first-year depreciation hit. Your $30,000 car is now only worth $24,000 on the market. You owe up to 28 grand on an asset worth 24 grand. Just like that, you are upside down by $3,000 to $4,000.
Which leads us right into part 4, why being underwater hurts.
Now you might be thinking, who cares? I'm just going to drive the car for years, so it doesn't matter if the math is a little off on paper.
Well, imagine this. You're driving your perfectly fine car a year after buying it, and bam, you get into an accident. The car is totaled. You think, no big deal, I have auto insurance. But here is the incredibly painful reality. Insurance companies do not care what you owe the bank. They only pay the current market value right now. So they hand over a check for $24,000. But the bank still demands the full $27,000 you owe them. That leaves a $3,000 gap, and guess what? You are legally on the hook to pay that $3,000 out of your own pocket for a car that doesn't even exist anymore. Crazy, right?
Or hey, maybe your life circumstances just change. You lose your job, or you move to a walkable city and you want to sell the car to ditch that $450 monthly payment. If you try to sell it, a buyer is only going to give you the $24,000 it's worth, but you need $27,000 to clear the title with your lender. You literally cannot sell your own car without bringing a personal check for $3,000 to the closing table. Until your loan balance finally dips below the car's market value, you're pretty much financially imprisoned by it.
There's this stark warning from our source material today that just hits the nail on the head. Quote, long-term car loans amplify the upside-down risk. The loan balance falls slowly, the car's value falls quickly. End quote. Seriously, a 6- or 7-year car loan is just a toxic combination. It keeps you paying mostly interest for years, which keeps that balance high, all while depreciation is just yanking the car's value down. It is a guaranteed recipe for staying underwater for a very long time.
All right, let's fix this. Part 5. How to borrow smarter. Now that we completely understand the trap, how do we avoid it? You've got to play defense. First up, consider buying slightly used, say 1 or 2 years old. Let some other guy absorb that brutal 20% hit in year 1. You get a practically new car with low mileage, but it's going to cost you way less. Second, always try to put a down payment of at least 10 to 20% on the vehicle. This instantly shrinks your loan size and builds equity right out of the gate so you don't start out underwater. And finally, choose the absolute shortest loan term your budget can handle. A 48-month loan is infinitely better than a 72-month one because you're actually paying off the principal much faster, outpacing the car's depreciation.
Now, if you are in a tight spot and absolutely must finance a car with zero down, there is a specific safety net available called gap insurance or guaranteed asset protection. Basically, it covers that scary difference between your loan balance and the car's actual cash value if it gets totaled or stolen. It's an awesome defense against that nightmare out-of-pocket accident scenario we talked about earlier. But honestly, the absolute best protection is just making sure you're not upside down in the first place by borrowing smart.
So we've totally uncovered the invisible cost of depreciation. We did the math, and we exposed the dangers of the upside-down loan trap. I want to leave you with this one final thought to chew on. The next time you're sitting at a dealership, getting ready to sign the paperwork for a massive purchase, ask yourself, will you be driving the car, or will the loan be driving you? Use these tools, borrow defensively, and stay above water. Thanks so much for hanging out with me on this explainer. Keep learning, and I'll catch you next time.